Listen-only mode.
Good morning and welcome to the webinar hosted by Sustainalytics and the Investor Responsibility Research Center Institute on a new report, How Investors Integrate ESG, a Typology of Approaches. Our agenda today is logistics and introductions, an overview of why this research was commissioned, an in-depth view of the report methodology, typology, prevailing types, and then we'll wrap up with some market observations, conclusion, and then we'll take your questions. In terms of logistics for the webinar today, all attendees are in listen-only mode, but we do encourage your questions. You'll notice you've got a control panel on your computer screen. Throughout the presentation, you can type any questions you have into the question box. Following the review of the research, we will read the questions aloud and respond to them. This session is being recorded, and we will post a replay of it after the webinar. It should be up later today at www.irrcinstitute.org. These PowerPoint slides also will be posted. We encourage you to share information on social media about this report and webinar. You can find us on Twitter at IRRC Research and at Sustainalytics. If you happen to have any audio issues during the webinar, please contact GoToWebinar at 1-800-263-6317. Our speakers today are three. The first one is John Lekumnik. He is the Executive Director of the IRRC Institute. And with the Board of Directors, he's led the organization to become a leading source of objective academic and practitioner research on an array of investment issues. He has decades of experience as an institutional investor, including time as the investment advisor to the New York City Pension Fund. John also is the author of the new book, What They Do With Your Money, How the Financial System Fails Us and How to Fix It, published by Yale University Press last year. Kevin Rainey is the Director of Product Strategy and Development at Sustainalytics. He's 20 years of experience in the fields of responsible investment and corporate sustainability and has worked with a wide variety of asset owners and investment managers, helping them to incorporate ESG considerations into their investment policies, strategies, and processes. He's an expert in the development of metrics and methods to evaluate sustainability performance and has led numerous projects involving the development of custom frameworks and metrics to measure ESG-related risk and impact. Also speaking today is Doug Morrow. He's the Associate Director for Thematic Research with Sustainalytics. He evaluates on a macro investment themes and cross-cutting investment risks and opportunities, including those related to climate change, global energy transition, water scarcity, data security, community relationships, and corporate transparency. Before joining Sustainalytics in 2014, Doug worked in a senior research role at Corporate Knights Capital and also held positions at ICF International and Innovest. Just a couple words about the IRRC Institute. It's a nonprofit that was established in 2005. It funds and disseminates unbiased research on a range of issues of importance to investors and other stakeholders. It's both academic and practitioner research. We offer an annual research award with two $10,000 awards. If you want to check out our website for more information on that. The deadline for submitting award submissions is October 6th of this year. There are more than 60 research reports available on the website at no charge. Sustainalytics is a global leader in ESG and corporate governance research, ratings, and analysis. It has 13 offices with 330 staff. Coverage includes a universe of 6,500 global equities, and we are in Sustainalytics is in 22 countries. And with that, I'll turn the presentation over to John for an examination of why IRC commissioned this research. John?
Thank you, Kelly. I also want to thank Sustainalytics in advance, and thanks to all of you for being on the line. For decades, many of us have suggested that ESG factors matter to the bottom line. And in recent times, much of the investing universe has begun to agree with that. There is now some 22.9 trillion in assets, which is managed with some type of ESG analysis. Managers ESG for a number of reasons. For some, it's a source of alpha. For others, it's an important risk control. Managers may look at things thematically, for instance, looking for investment opportunities around the transition to a low carbon economy. And others may look at a security company by company level as an understanding of how the potential portfolio companies fit into whatever their ESG themes are, and or how the companies themselves, from a bottom-up basis, are dealing with their ESG issues and whether they're managing them correctly in a risk control and opportunistic way. There are business reasons as well why the asset management industry has turned to ESG. Many asset owners require their managers to have some sort of ESG analysis and integration. And a factor which doesn't get enough attention, to attract talent, particularly new talent graduating from school, managers basically need to have an ESG philosophy of some type or other. These are issues which many in the community care about, and certainly many new graduates care about, and so it is a way to attract talent. So the result of this is that ESG has gone, for lack of a better word, mainstream. The problem is that everyone claims that they do ESG integration, and it's sort of become a meaningless phrase. It makes people feel good, but it has a very limited descriptive use. It doesn't say what the manager actually does. Next slide, please, Kelly. So as a catchphrase, ESG integration, I've heard, has been used for everything from deep analysis, taking ESG factors into account at every level of the investment decision. Now, even sophisticated beneficial owners get frustrated on this. I've been having a dialogue for the last 2 weeks with the CIO of a $60 billion fund. This is obviously not a small fund, well-staffed, knowledgeable. And he expressed frustration at the fuzziness of the due diligence process of how does he get his hands around how asset managers actually think about these factors. So the IRC Institute issued an RFP, a request for proposals, a tender, for a typography of how managers integrate ESG. And the instructions to the bidders were, we want you to be granular in your finding. Who integrates ESG at the firm? What is it that's integrated? How is it done? Next slide, please, Kelly. Sustainalytics won the bid. And I think that when you read the report, you'll agree that they did a very good job. It's not the final word on the subject. Sustainalytics would not say it's the final word on the subject, but it may be the first word in establishing an analytical framework and a semantic of vocabulary that is useful for understanding exactly how asset managers integrate ESG, and it can be built upon in the future. Let me tell you what I mean by an analytical framework and a typography and the semantics. If I ask a money manager, how do you invest money? And they tell me, I'm a fundamental bottom-up small cap value manager that does deep research and has a concentrated portfolio, I can understand what that means. I have an instant idea and I can diligence against it. I can say whether that's a style I want or not. If someone just said I integrate ESG, that doesn't mean anything. But if you now say I have centralized ESG resources with mandatory consideration at the security level, or I have mandatory top-down thematic consideration of ESG risks and opportunities, I can begin to understand what they do. That's really important. By the way, in the couple of weeks since this report has been out, the response has been extraordinary. We have held, this is the third webinar we are doing today. We did one for Europe, we did one for North America at different time frames, and both of them, well, the American one was the most populated webinar that we've ever done. Both of them were among the most populated we've ever done. I've personally received more than 100 comments in the last 2 weeks, and literally 99% of them are positive. In other words, it seems that I wasn't the only one frustrated by the lack of clarity in the phrase ESG integration. So I'm very pleased that the investment communities recognize the utility of having a strong analytical framework through which to analyze this ESG integration phenomenon. And with that, let me turn this over to Kevin and Doug to walk us through the findings. Kevin?
Thanks, John, for setting the stage really well. And thanks to all of you for joining us today. We're really pleased to have had the opportunity to work with the IRC Institute on this project and now to present the outcomes. And we really do hope that this typology serves to help clarify conversations about what ESG integration really means in practice, and to help investors navigate through this evolving space. We see the typology as building on past work of various others out there, most notably the PRI, which has produced a few really useful reports with plenty of examples of techniques to integrate equities in particular. With this project, our aim has been to really home in on the key or essential differentiators that exist between integration approaches that we see in the market, trying to encompass a broad range of variables, including organizational and process-related aspects of integration, and then to use all of this to build a typology. And it doesn't capture all of the details or all of the nuances of the various approaches, but we do hope that we've identified the most important ones. I want to note also that our aim is really to identify and classify rather than to pass judgment on different approaches. So we don't say in the report which is more effective or which produces better results. We didn't set out to answer those questions. Next slide, please. So a few notes on methodology here. So the typology assumes what I would consider to be the prevailing general definition of ESG integration, which is the incorporation of material ESG factors with the aim of enhancing returns. Now, a quick related note here on one specific practice, screening or filtering using ESG factors, which is a practice that's used by numerous investors that integrate ESG. So in this typology, we treat screening as a technique of integration if it is at least in part motivated by an investment case. That's what has to be there throughout. As opposed to being motivated solely by the goal of complying with norms or managing reputational risk. A note about scope as well. The typology focuses on portfolio management itself. So it doesn't encompass activities such as engagement, which some investors see as playing a very important role in informing their investment analysis. And indeed, it is a very important thing to be doing. But this typology encompasses the structures, the processes, and the methods involved in integrating into portfolio management itself. Our process began with the development of an initial analytical framework consisting of 18 indicators that we used to structure the research that we did. This framework was informed by the PRI reporting framework, as well as our own in-house awareness of integration practices in the market. We then examined the practices of 70 investors, almost all of which are PRI signatories, reviewing their PRI transparency reports and carrying out interviews with half of them. The sample that we selected, we aimed to make it a wide cross-section of the market with diversity with respect to size, geography, position in the market, experience with ESG integration. There are most of those that we looked at are focused on listed equity, although there are some focused on fixed income as well. Most focus on active, but there's lots of passive in the mix. And then one final methodological note, the unit of analysis for the study is the approach that individual portfolio management teams take, rather than whole firms or organizations. So what this means is that with some investment management firms, especially larger ones, there are multiple approaches in place for many of them, and this is certainly something we observed. Next slide, please. So here is the typology at a high level. It consists of 3 core dimensions, and in short, they are management, or how ESG-related functions are organized and managed. In other words, the who of integration. Secondly is research, the nature of the research and analysis that is used. In other words, the what of integration. And then thirdly, application, which is focused on what kinds of techniques are employed, and this we call the how of integration. So within each of these 3 core dimensions, we identified what we observed to be the most important differentiators among the approaches, and we identified 2 in each case. So we've got a total of 6 differentiators across 3 dimensions. So in the next 3 slides, I'll delve in more detail into each of these dimensions. Next slide, please. So management, again, is about how the various functions and roles related to integration are organized and managed. And the first key differentiator here addresses the degree to which these functions and related responsibilities are centralized. And there is a continuum here, as there is for most of the differentiators that we identified. So at the centralized end of this continuum, you're likely to find dedicated ESG personnel or specialists or teams who are carrying out, for example, materiality analysis that they then pass on to portfolio managers. In a fully decentralized approach, there are unlikely to be dedicated roles, and responsibility lies fully with the individual portfolio managers to integrate in whatever way they deem appropriate. The second key differentiator under this dimension focuses on whether or not there are processes or mechanisms in place to ensure that ESG factors are integrated. And to clarify, when I say integrated here, I don't necessarily mean that they affect the outcome of an investment decision, but that they are at least considered. So such a mechanism might involve, say, a requirement that portfolio managers document if and how ESG factors were considered to be material, and if and how they were actually incorporated into an investment decision. So these 2 key differentiators are independent of one another. So a given approach can be classified on any of the 4 quadrants that you see in the graphic on this slide, and that's the case for all 3 dimensions. Just a few noteworthy findings here. We heard differing views on the pros and cons of centralized versus decentralized approaches. And we heard from some interviewees that are more centralized that while they see the role of ESG specialists as being very important, they also aim to move toward less centralization, seeing it as a better way to really embed ESG into the daily work of portfolio managers. But again, there are differing views here. We also heard differing views regarding the necessity and effectiveness of the mechanisms that some use to ensure integration. Some view these as important to ensure a consistent approach. Others see them as unnecessary and assume that a good portfolio manager will figure out what's material and will consider it anyway. The one thing that we did hear clearly from some interviewees is that that creating a team culture that recognizes the value of integration is probably the most effective way to ensure that it does happen. Next slide, please. So the second major dimension of the typology is research. And here, the typology is looking at the type of ESG information and analysis that is actually being integrated. The first differentiator focuses on the breadth or the scope of research, which ranges from what we call narrow to broad. So by narrow, we mean research on the ESG relevant characteristics of individual companies. And this includes many metrics that you're all familiar with, I'm sure, and metrics that address or assess governance practices, health and safety, etc. There are a great many. In contrast, broad research includes this company level information, but it also includes information and analysis of macro level or thematic trends related to ESG that may interact with the company specific factors and influence value. And examples of this kind of analysis would include analysis of stranded assets risk, or water scarcity, demographic changes, etc. So the second key differentiator in this dimension is about if and how the inputs used by portfolio managers have been modified internally in some way. So are data and or scores from external providers taken as given, or does a team have a process to modify externally sourced data and research using, say, an internal scoring model, or a process to select certain metrics in line with in-house materiality analysis, for example. So a couple of findings here. We heard a growing recognition from many interviewees of the importance of considering broad research. In other words, research that includes these broader ESG trends and macro issues. And yet, in practice, many are really struggling with this, and most are not, in fact, integrating at that level. We heard from many that it's a real challenge to quantify the expected effects of macro issues, especially given the systemic nature of many of these issues. So it's a real area of challenge and of development for the industry. And then a second observation is that those that are doing the customized analysis using in-house tools, carrying out their own materiality analysis systematically, they are more likely to be modifying inputs in a way that reflects their in-house analysis. In other words, in the modified ESG inputs quadrant as opposed to the unmodified quadrant. Next slide, please. So the final dimension is application. And this dimension focuses on the question of how investment teams are applying ESG information in their investment process. The first differentiator is about if and how top-down techniques are used, and second is about if and how bottom-up techniques are used. And these are separate in that both can be practiced. It's not either or. It's important to note here that the definition of top-down in the typology is a bit different from how it's often defined. So I just want to clarify that further. Top-down integration here involves the the development and execution of an investment thesis that's based on a general view of how ESG factors may create investment risk and opportunity, as opposed to a very company-specific view derived from fundamental analysis. So top-down techniques are most often rule-based, although they may also involve a general view of an industry or a business model as a whole. And examples would include filtering a universe or reweighting an index based on material ESG factors. And these top-down techniques can be applied to both active and passive strategies. Excuse me. So bottom-up integration, in contrast, is the integration of ESG into security-specific fundamental analysis, using ESG, for example, to adjust the discount rate in a model or various other things. I want to highlight here that top-down and bottom-up techniques can incorporate both narrow research and broad research, as we've defined these under Dimension 2, the research dimension. So to wrap up with a couple of final observations for this dimension, one is that screening is one of the more common top-down techniques in use, and the rationale, in order to be included in our typology, needs to be grounded in an investment case. But by many interviewees that we spoke with, these techniques are also often seen as having value from the perspective of mitigating sustainability impacts. And indeed, the two rationales are often seen as aligned in important ways, especially given the systemic nature of the way that many ESG issues will affect value over time. And then a second interesting finding that we heard was that the goal of limiting tracking error can sometimes act as a constraint on integrating ESG, especially with respect to integrating a longer-term view on how the impact of macro or thematic trends may affect certain sectors. And yet, there's generally, or for many at least, a reluctance to deviate too much from the weightings in the benchmark, even if some ESG signals may be suggesting that there's a rationale for doing so. So that's an overview of the typology. I'll now pass it to my colleague, Doug.
Thanks very much, Kevin. So in addition to developing the typology itself, we were also interested in identifying what we refer to as the prevailing types of ESG integration in today's market. So our task with this part of the study was to look at all the permutations yielded by the typology and identify those that were not only well represented among the 70 investors that we looked at, but also distinctive in terms of their overall position in the market. So as you can see here on the slide, we landed on 6 distinct prevailing types of ESG integration, and you can also see the pathway through the typology to get to each of these prevailing types. And as we said before, it is difficult in many cases to bucket a single investor into any one of these prevailing types, and that's primarily because, especially at large shops, it's not uncommon to find them simultaneously running multiple ESG strategies. So I think, but nevertheless, I think the real value add here is that these prevailing types, they help characterize important differences that investors are taking with respect to ESG integration. So what I wanted to do now is briefly go over the key findings from each of these prevailing types. So if I can have the next slide, please. Thank you. So the first one is what we call the believer. Now this is a type of ESG integration that involves a really clear structure and a consistent approach across an organization. Now, notable features of the believer include the use of top-down techniques, i.e., as Kevin said, that involves taking a general view about how ESG-driven risks or opportunities may play out in the market, as well as the use of narrow research, as you can see on the slide. So an example of what an approach that the believer might take would be underweighting portfolio companies with a worst-in-class ESG score, such as bottom 5% for the industry. And then, as we'll see, like the cautionary and the statistician, the believer centralizes ESG responsibilities and has a process to ensure that ESG factors are considered in the investment process. The next slide, please. Thank you. So the cautionary, this type is distinguished by the use of bottom-up integration techniques, such as adjusting cash flow projections or the discount rate in a company's DCF model, and narrow ESG research that is largely unmodified. So this would include things like overall ESG scores or company performance on individual metrics like energy intensity and things like that. So the integration methods here at the cautionary are a little bit less systematic than those of the believer. Although, as you can see on the slide under management, the cautionary still has a system in place to facilitate the actual use of ESG information. Next slide, please. Thank you. Now, as the name implies with the statistician, this is a type that's really focused on unearthing statistical relationships between ESG factors and either firm level or portfolio level financial performance. Unlike the believer and the cautionary, this type is really characterized by modified ESG inputs, which, as Kevin said, refers to external ESG research that is then augmented with in-house analysis. An example would be things like factor weights. However, like both the believer and the cautionary, the statistician does use a centralized approach to ESG management. Again, this would be like ESG specialists who are sitting either within or outside of investment teams, and it also has a process to ensure integration. Now, another noteworthy point about the statistician is it's likely to encompass most, but not all, passive managers. Next slide, thank you. So the discretionary, this type is unique among the 6 prevailing types in that it's the only one that lacks a process to ensure or encourage the uptake of ESG research into investment decision making. So that shows up on the slide under management, as you can see. And then coupled with the use of unmodified ESG inputs and application that's neither focused on top-down or bottom-up, this type generally reflects a lack of conviction about the financial value add of ESG integration. So teams that fall into this approach type usually don't have an organizational view on how ESG factors may affect value, and PMs and analysts would typically have a lot of latitude in determining not only the relative importance of ESG research in the final decision-making process, but also whether or not to use it at all. If I can have the next slide, thank you. The transition focus. So this type is really in many ways the polar opposite of the discretionary. Hallmarks of this type include things like decentralized ESG management, the use of broad ESG research that is modified with in-house data and analysis, and as you can see on the slide, a combination of both bottom-up and top-down integration techniques. So what this looks like in practice would include things like a structured assessment of macro themes like water scarcity, climate change, or the shift to healthy eating, or underweighting fossil fuel companies based on a stranded asset risk. And then this characteristic lives below the typology in some ways, but approaches that fall to this type are usually associated with a high degree of conviction on the part of PMs and analysts about the potential of ESG information to add genuine investment value. And also ESG is often a central part of a firm's culture. And the final prevailing type is what we call the fundamentalists. And as you can see, it's broadly similar to the transition focus, but it is distinguished by greater emphasis on bottom-up techniques. So that shows up on the slide under application. So examples would include things like scenario analysis to forecast possible outcomes of ESG events or controversies like pipeline spills, or considering how companies stand to be affected by carbon pricing. Now, along with the transition focus, I think it's important to flag that this is the only prevailing type where ESG responsibilities rest with investment teams as opposed to a dedicated ESG staff. So just to summarize, as we said earlier, not every investor will fit perfectly into these 6 prevailing types because the typology, like any framework, involves a simplification of reality. But as Kevin said earlier, we do hope that this prevailing types analysis provides a new tool and a vocabulary to help the market make more informed sense about how investors are approaching ESG integration. Thank you. Now, for those of you who have already seen or read the report, you'll know that we closed out by offering 5 high-level observations about the general state of play of ESG integration. Now, not all of these observations are expressed or reflected in the typology or the prevailing types, so we really present them more as just general findings that were driven by our research and interviews. So the first observation is simply that it's actually quite difficult to know in some ways precisely how much ESG integration is going on in the market. This is partly due, on the one hand, to a lack of conviction, as we said earlier, about the risk and return benefits of ESG information on the part of some PMs and analysts, even at managers and asset owners that have expressed support for ESG integration, for example, by becoming a signatory to the PRI. And then coupled with a lack of reporting mechanisms at many organizations, as we discussed earlier, it really supports the view that many investment teams are likely not fully utilizing all the ESG research that they have access to. But on the other hand, it's also possible that genuine and innovative integration is occurring at organizations that have not publicly embraced ESG. So I guess the takeaway here is really that depending on how high one sets the bar, it's actually quite challenging to determine how much integration is going on. A second high-level finding that came through our research was that meaningful ESG integration can still be difficult. Again, this builds on what Kevin was talking about earlier, but despite the surge of investor interest in ESG that we're all familiar with, and the growth in global AUM that incorporates ESG, as John said at the beginning, many interviewees signaled to us that genuine integration can still be quite challenging. And several singled out the practice of bottom-up techniques in particular, such as adjusting a company's projected cash flows or discount rate in a DCF based on their ESG performance. Many signaled this out as being particularly challenging. So despite the numerous examples that we cite in the report about ESG integration using bottom-up techniques, I think it's clear that this is still very much at an early stage in the life cycle. So another high-level finding is simply that concerns about ESG research continue to be fairly widely documented. Many interviewees signal concern about things like research timeliness, transparency, and geographic coverage, especially with respect to emerging markets. Now, of course, as we all know, I think many of these concerns reflect a relatively brief history of ESG disclosures, and many investors and interviewees signaled or cited that they'd seen a notable improvement on some of these measures over the last few years. But to us, nevertheless, this observation really underscores the importance for the users of ESG data and research to triangulate, where possible, corporate ESG performance data or corroborate different sources of ESG scores. And then another high-level observation, again, this touches on something Kevin mentioned earlier, was around this idea of tracking error constraints. So several managers that we spoke with indicated that tracking error limits set by asset owners are really constraining the extent to which they can incorporate ESG information into their portfolio strategies. And in many ways, this observation is similar to the long time complaint by fundamental managers that tracking error limits mean that investors want active management, but not too much active management. So there is a parallel there. So to us, this means that more empirical testing of the impact of ESG integration on things like portfolio volatility is needed before such constraints are likely to be relaxed. And then finally, an observation that was supported by our research is that for many investors, the line between, on the one hand, maximizing risk-adjusted returns, and on the other hand, minimizing corporate, social, and environmental impacts is blurring. Many interviewees talked about an investment case for aligning their holdings with the broader goal of creating a sustainable economy. And this is particularly important given the renewed talk about the importance of integrating a systemic perspective into investment decision-making, a point that's been made by many groups, including the Investment Integration Project. So if I can just have the next, thank you. So just to wrap up, some concluding thoughts. As we said earlier, we hope this typology and the prevailing types that we went over today help provide a flexible analytical framework that investors and indeed other stakeholders can use to organize the growing diversity of ESG integration approaches that we see in the market. We also hope that this study promotes discourse and discussion and provides clarity about the essential features of ESG integration. So as investors' interest in this ESG continues to grow, it'll be interesting to see if those key differentiators change over time, and that's something that we intend to monitor. So with that, I'll pass it back to Kelly for the Q&A.
Kelly, I think you're muted somehow.
I am. Thank you so much. Sorry about that. So thanks everyone for your attention. We are on to the Q&A portion of the webinar. If you do have questions, you can type them into the question box in your control panel. We'll read the question out loud and respond to it. And we can go from there. So the first question we have is, can you explain further how you selected the 6 prevailing types?
Sure, I can take that one. The prevailing types are really driven by 2 factors. One was frequency. So, all of the 6 prevailing types were generally, highly represented among the 70 investors that we looked at. But it wasn't simply a case of, determining or choosing the 6 most widely represented. We also injected a flavor of distinctiveness. It was important to capture prevailing types that were, particularly important. So an example would be the statistician. It wasn't as heavily represented as some of the others, but we wanted to include it because of its distinctiveness, given the trend in the asset management industry towards passive and away from active.
Thank you. The next question, can you share how boutique managers compare to larger managers? Do they tend to fall under specific categories?
Yeah, I would say that the main difference that we saw, and that I would generally expect to see between smaller boutique managers on the one hand and larger ones on the other, is that at large investment management firms, as was noted earlier, you're more likely to find a diversity of approaches in practice, and perhaps less likely to find sort of a firm level view, a single firm level view of how ESG should be approached. With smaller managers, I mean, there's variety there, of course, but if there is ESG integration going on, I think there's a greater chance that there will be sort of a firm level view, and in many cases, of course, integration and sustainability are central to their brand.
Thank you. The next question, can you explain in more detail about the sample of 70 investors? How were they selected, for example?
Sure, I can address that. So, yeah, I mean, as Kevin said during the brief description of the methodology, it was really important from the get-go for us to choose a broad cross-section of the market. So there was a purposeful intent to choose diversity of investor by geography, by investor size, and I think maybe most interestingly also experience with ESG integration. So we purposely selected some managers that were relatively new to ESG integration. And then as for geography, as I said, it was fairly widely dispersed. We had 20, maybe with a slight tilt towards the US, we had 27 firms from the US, 12 from the UK, 16 in continental Europe, 7 in Australia, 7 in Canada, and 1 in Japan.
Thank you. Our next question, does your framework accommodate passive and active managers?
Yes, that is certainly the intent. I think, I mean, the way in which it speaks to active, I think is fairly straightforward. I'll assume the question is sort of more a question about passive, and there is a clear place for passive in the in each of the 3 dimensions. I think, I mean, yeah, and I'll just speak very briefly to each of the 3. I think that one of the defining characteristics of passive is that it is what this typology calls top-down, in that it's rule-based, and so that's where it sort of comes out in that 3rd dimension. It's all top-down and no bottom-up. It's really in the second dimension, which is about research. That's where we actually see a considerable variety in the passive strategies that are out there. So most would be using what the typology calls narrow research, company-specific information. Some are attempting to integrate a consideration of broad research. What's the other, just drawing a blank on the other differentiator there. With respect to inputs, whether they're modified or unmodified, we see that as well in passive strategies out there. So yeah, again, the answer is yes. I think we think that it accommodates both pretty well.
Thank you. Our next question, do you have any comments on ETP or ETF managers with regard to your research?
No, I mean, John, feel free to chime in.
Sure, let me take that one. I mean, exchange-traded product, exchange-traded funds is a legal structure. It's not an investment style. So to the extent that they're tracking an index, you're going to, and they have an ESG philosophy, whether it's a best in class or we only invest in green bonds or whatever it is, it would follow the same sort of index passive discussion that Doug just mentioned. To the extent that there are a few active ETFs, the fund management industry is looking to create more. It would be the same structure of it necessarily changes the analysis that you would do about them.
Yeah, agreed.
Terrific. Thank you for that response. And that looks like that concludes our questions. We thank everyone for your insightful questions, and we thank you for your attention this morning. If you have any follow-up questions, Kevin, Doug, and John certainly are available to respond to them. Their contact information is here on this PowerPoint. Again, this session was recorded, and the PowerPoint and that recording will be posted on www.irrc Institute later today. Again, thank you for your attention, and we hope you have a nice day. Thanks.